Thanks for having me.
First of all, why is everyone fleeing out of muni bonds? What gives?
That's a great question. Obviously, with the way the market is performing, we've actually outperformed treasuries. And so we're kind of wondering why everybody's sitting on the sideline and not trying to get in.
Are they just yield hungry? I mean, is it concerns about the quality of the munis? Is it concerns about rates moving higher? Or do they just think, why be involved in munis when I can go get 4% on Apple's new product or whatever?
Yeah, so I think there's actually a lot of things factoring into it. Part of it being some, concerns around the banking crisis and, what impact that could have, as well as the fact that, rates have been rising, inflation has been up, and a target of what the Fed is trying to do. So all those factors, I think, are keeping people on the sidelines. It's going to be an interesting week this week. In fact, we have a very large supply hitting the muni market this week, about $12.5 billion. It's the biggest week of the year. So we'll see how that all gets digested.
So where would you say we kind of mentioned there's a couple of places in particular you would tell people to look. What are those places?
So there's a couple of sectors that we're eyeing carefully. And, one of the things that we say is when you have a really strong research staff like we do, we enjoy digging in deep into these credits and really trying to understand the nuance between them. As we come off of COVID, which was really an outstanding period of time from a fundamental perspective, credits across the muni spectrum are doing better than they were pre-pandemic. Federal COVID aid is a large reason why that is the case. It helped cities and states and counties and transit, all different types of issuers get through the pandemic, regardless of ridership trends or whatever, and allow them to avoid default and really focus on trying to get essential workers where they wanted to go. But that aid is starting to, people have to wean themselves off of that. And the two sectors we're watching closely are really nonprofit healthcare and transportation. I'll take nonprofit healthcare first. Obviously, this was, a central and extremely important sector as we went through COVID, and that is, nothing to, be upset about. But the pressures from inflation and the strong labor market had make it very difficult to get enough workers to work. And so hospitals have to go to agency or traveling nurses, as many people may know them as, and that's expensive. Sure. And so it's been eating into margins. So we continue to watch that sector and see, how they are from a regional perspective, getting more employees hired locally so they can wean themselves off of.
And I can't imagine that people are rushing in and saying, hey, let me load up on New York City subway debt, for instance, or whoever the, provider is. Is that true across the board, though?
So it's not true across the board. We're seeing a lot of regional differences. And in terms of ridership for mass transit has not come back. And that's pretty much across the board. But we're seeing it exacerbated in certain communities that have really seen adjustments in, returning to office versus work from home. We hear a lot about commercial real estate. So for mass transit, trying to get riders has been a challenge. And now that the COVID aid is starting to expire, it's up to these transit agencies to figure out how they're going to balance their budget, whether it's service cuts, additional tax revenue, or more state and local aid.
Yeah, and then Speaker McCarthy on our air this morning saying he wants to see people return unspent COVID aid. So, but maybe now, now I understand why muni investors are nervous. No, there's a lot more going on than just nonprofit hospitals and transit. Jennifer, appreciate the granularity. Thanks for your time today.